Alright, let's dive into Arvind Fashions Q4 Financial Year 25 results presentation. I see the standard disclaimer on the initial slide, so we'll skip over that.
Sounds good. No need to dwell on the legalese.
On the next slide, we have the agenda, which outlines the structure, performance highlights, the results themselves, and then the way forward. Pretty standard stuff.
Okay, let's jump to the meat of it. What are the performance highlights they're touting?
So, on the next slide, they lead with a market and economy update. It seems like things are a bit mixed. They highlight premiumization as a continuing trend, which is good for them, but they also mention that consumers are gravitating towards stronger and established brands, which could present a challenge for smaller players or newer brands in their portfolio.
And what about the early onset of EOSS, the end of season sale? Is that impacting margins?
They do mention higher discounting across the industry because of that, which definitely squeezes margins. The slide also notes changing weather patterns impacting consumer buying behavior and a muted consumer demand environment overall, so a bit of a mixed bag. Premiumization is good, but broader economic factors are providing a headwind.
Okay, so the market isn't exactly booming. How did Arvind Fashions perform against its own objectives?
The next slide outlines their financial year 25 objectives and their achievements. On sales and profitability, they aspired to double-digit revenue growth but achieved about 8.5%. However, they did manage EBITDA growth of 17% with a margin increase of 100 basis points year over year. They're also claiming comparable PAT growth of 70% plus.
That's a substantial difference between the aspirational double digit and the actual 8.5%. How do they explain that discrepancy?
They don't, at least not explicitly here. However, they do mention the challenging demand environment again. It seems they're attributing the shortfall to overall market conditions. They do highlight that, despite missing their revenue growth aspiration, they improved profitability.
Okay, makes sense. What about their other objectives?
Well, they wanted to improve brand salience through advertising and product innovation. They claim increased advertising spend and multiple product innovations. They also aimed for superior retail operations, which they say resulted in a 5.5% retail, like-for-like LTL growth and a gross margin increase of 130 basis points.
That LTL growth is a pretty good indicator of retail execution.
Agreed. On store expansion, they aimed for around 150 gross openings, largely through the FOFO franchise-owned franchise-operated route, with a significant net square footage addition. They opened 120 stores, so they didn't quite hit that target, but still a solid number.
And what about working capital and debt? That's crucial.
They aimed for higher free cash flow, continued deleveraging, and further improvement in ROCE and ROE. They say net working capital days remained stable, stock turnover was around 4x, gross debt was lower by 76 crore rupees year over year, and they achieved a ROCE of over 20%.
Hitting a 20% ROCE is a major milestone. So overall, it seems like they mostly delivered, despite the tough environment.
Exactly. Now moving on to the next slide, which summarizes the Q4 financial year 25 business highlights. We can see that revenue momentum continued with about 9% growth year on year, despite the muted market conditions.
Good to see that growth continuing. Were there any particular growth drivers?
Yes, premiumization across brands is mentioned again as a key driver. Adjacent categories like womenswear and innerwear also witnessed strong growth. They added 30 new EBOS and online direct-to-consumer business grew by over 20% year on year.
That's great to hear about the online growth. What about the channel-wise performance?
The retail channel grew by about 15% with healthy LTL and lower discounting. They say revenue mix is higher at 42%. However, the wholesale channel experienced slower growth year on year.
Okay, that channel mix shift is interesting. Shifting to a more direct retail and online presence is generally margin accretive. And what about profitability?
EBITDA stood at 170 crore rupees, which is about 15% growth year on year. EBITDA margins were higher by about 80 basis points due to better channel mix and lower discounting. PAT from continuing business grew about 8%. They highlight that the overall growth for financial year 25 was over 70%.
Strong EBITDA and PAT growth. How are they managing their working capital?
Net working capital days remained stable. Inventory was lower by 3 days and stock turns were about 4x. They also achieved their guidance of ROCE being over 20% despite the tough growth environment.
That's a very healthy ROCE. What's this asterisk next to PAT though?
Good catch. It says PAT excludes 120 crore rupees of exceptional DTA impact in Q4 financial year 25.
DTA. Deferred tax asset? What's that about?
Luckily, the next slide explains this DTA charge explained. Apparently, one of their wholly owned subsidiaries, Arvind Lifestyle Brands Limited ALBL, had accumulated losses from prior years, particularly during COVID. They had created a deferred tax asset on those losses at a rate of 35%.
Okay, that's standard accounting practice.
Right, but management has now decided to move to a lower tax regime, around 25%. This will help optimize the tax charge on future profits, but it necessitates a one-time tax charge of 105 crore rupees in Q4 financial year 25.
So a non-cash charge to reflect the change in tax rate.
Exactly. There's also a smaller amount, 15 crore rupees related to expired tax assets. The slide emphasizes that this 120 crore rupees charge is non-cash and has no impact on the company's cash flow.
Got it. So excluding that charge, PAT for Q4 financial year 25 would have been 27 crore rupees, representing 8% growth year on year, and 85 crore rupees for financial year 25, which is 70% plus growth year on year.
Precisely. They also state recurring benefits from this change. A saving of approximately 10% tax due to lower tax regime, leading to increase in reported PAT in the future, and an increase in consolidated ROCE by 150 to 200 BPS due to lower capital employed.
So a short-term pain for long-term gain. That makes sense.
Before we get into the channel mix, let's quickly touch on a couple of slides we skipped earlier that highlight the company's operational performance in Q4. First, despite a muted market environment, Arvind Fashions delivered strong sales growth. Revenue was up about 9% year-on-year, rising from 1,094 crore rupees in Q4 FY24 to 1,189 crore rupees in Q4 FY25. This growth was driven mainly by direct channels. Retail saw a 5.2% like-for-like increase, and online B2C sales grew by over 20%. The revenue mix from retail also increased to 42%, and they managed to reduce discounting. Wholesale, on the other hand, saw slower growth. They also expanded their store network, with the EBO count reaching 977 as of March 25, and a net addition of about 46,000 square feet.
That's impressive, especially considering the tough market. Direct-to-consumer channels really seem to be paying off for them.
Absolutely. The next slide focuses on profitability. EBITDA for Q4 FY25 was 170 crore rupees, up from 148 crore rupees in Q4 FY24, a 15% increase. The EBITDA margin improved by about 80 basis points year-on-year thanks to a better channel mix and lower discounting. Profit before tax rose from 54 crore rupees to 66 crore rupees, and profit after tax, excluding the exceptional DTA impact, increased from 25 crore rupees to 27 crore rupees.
So not only did they grow the top line, but they also managed to improve margins and profitability. That's a strong performance in a challenging environment.
Exactly. Now let's talk about the channel mix. On the next slide, the channel mix shows that in Q4 financial year 24, wholesale accounted for 40%, retail 35%, and online and others 25%. In Q4 financial year 25, wholesale decreased to 33%, retail increased to 42%, and online remained at 25%.
So retail is clearly gaining share at the expense of wholesale. As we discussed, this shift is generally positive for margins.
Exactly. Jumping to the next slide, they're highlighting the financial year 25 performance numbers. Exactly. Jumping to the next slide, they're highlighting the financial year 25 performance numbers. Sales, EBITDA percentage, gross margin percentage, and return on capital employed are all shown for financial year 22 through financial year 25.
Okay, so we can see the trend over the last 4 years.
Yes, sales have grown from 2,784 crore rupees in financial year 22 to 4,620 crore rupees in financial year 25. EBITDA has grown from 254 crore rupees to 637 crore rupees, and the EBITDA margin has steadily improved from 9.1% to 13.8%. Gross margin percentage has also seen a strong improvement, rising from 45.2% in FY22 to 53.5% in FY25, an increase of 830 basis points. And if we look at return on capital employed, it's a remarkable turnaround from negative 2% in FY22 to over 20% in FY25.
That's really impressive. So not only are they growing the top line and improving profitability, but they're also getting much more efficient in how they use their capital.
Absolutely. It's a consistent track record of financial improvement across all key metrics.
Consistent growth and improving profitability. That's what investors want to see. The next slide breaks it down in percentages, right?
Correct. It shows growth acceleration compared to financial year 24. Revenue growth for financial year 25 was 8.5%, significantly higher compared to the previous year. They reiterate that there was double-digit growth in retail and 15% plus growth in online channels, but slower growth in wholesale. The net square footage addition for financial year 25 was about 1.22 L.
That's good accelerating growth. What about profitability on this slide?
EBITDA increased from 544 crore rupees in financial year 24 to 637 crore rupees in financial year 25, and EBITDA margins improved by 100 bps year on year. This was aided by favorable channel mix, control over discounting, and various other cost controls. They're attributing this to operational efficiencies. The slide also shows PBT and PAT growth, with the asterisk highlighting the DTA impact again.
Right. The DTA charge we already discussed. And the next slide shows channel mix again, but for the full year.
Correct. It's very similar to the Q4 breakdown we saw earlier. Wholesale has decreased from 42% in financial year 24 to 43% in financial year 25. Retail has increased from 31% to 29%, and online remains consistent at approximately 27%. No major shift here.
They follow this up with some visuals from a few brick and mortar stores.
Correct. There are 3 slides showing store photos. It's highlighting the strategy of continuing to open marquee EBOs, showing images from Club A Gurgaon, Infinity Malad Mumbai, and HSR Bengaluru.
Okay, moving past to the marketing photos, on the next slides we see brand highlights.
This section offers a slide for each of their power brands. For US Polo Association, they state it witnessed strong growth momentum during the year, with higher market share gains and dominant leadership position in casual lifestyle category across channels. Brand touched 2,000 crore rupees NSV in financial year 25. Significant investment in advertising during Q4 helped deliver strong LTL growth, and they plan to continue to deepen retail presence through larger square foot stores.
Okay, that makes sense and tracks with the advertising spend and retail focus discussed earlier.
For Tommy Hilfiger, the brand states there was significant improvement in EBITDA margins and other KPIs. They are continuing the growth agenda, with emphasis on product innovation, e.g. premium Italian shirt collection. Arrow New York continues to see traction while attracting younger customers and focus on accelerating EBO's expansion.
So focus on margin improvement, innovation and expansion for Tommy Hilfiger.
Flying Machine delivered strong LTL in Q4 along with growth across other channels. The brand witnessed sharp turnaround in H2 financial year 25 and is well poised to improve financial performance backed by growth and operating leverage over coming quarters.
Good turnaround story for Flying Machine. Any insights for Arrow and Calvin Klein?
For Arrow, they highlight strong brand pull and favorable tailwinds around premiumization continues to aid brand's strong financial performance. Focus on expanding retail and online presence through innovative retail formats.
Okay.
Calvin Klein states that premiumization trend helping brand deliver industry-leading sell-throughs and LTL growth. Strong growth and profitability in financial year 25 despite challenging demand environment.
So across the power brands, consistent themes of focus on premiumization, marketing and retail growth.
That sums it up. The next slide then summarizes the group-wise performance for Q4 financial year 25.
Let's see. So for the power brands group, sales for 1,189 crore rupees in Q4 financial year 25, up 9% from 1,094 crore rupees in Q4 financial year 24. EBITDA was 170 crore rupees, up 15% from 148 crore rupees. And the EBITDA margin was 14.3% compared to 13.5% in the previous year.
And the following slide provides the same breakdown but for financial year 25. Sales grew 8.5% to 4,620 crore rupees. EBITDA grew 17% to 637 crore rupees. and EBITDA margins expanded by 100 bps to 13.8%. They attribute that to revenue growth acceleration coupled with operational efficiencies.
Those are strong numbers. The next few slides are just a summary, right?
Correct. One slide presents a snapshot of Q4 financial year 25 performance, showing revenue, EBITDA, PBT, and PAT. But the important part is the asterisk mentioning the 120 crore rupees DTA charge again.
And the next one does the same for the full year.
The following slide shows the balance sheet as of March 31, 2025, compared to the previous year. Net worth is slightly down, borrowings are lower, capital employed is lower, inventory and receivables are up, creditors are up, net working capital is up slightly, net fixed assets are up, and other assets are down.
Okay, a mixed bag on the balance sheet. It seems like they've managed to reduce borrowings, but working capital has increased slightly. Anything specific driving that increase?
We can check on the following slide, which focuses on efficient working capital management. Inventory turns remained stable at about 4x. Inventory days increased slightly from 94 to 91. Receivables days increased from 47 to 54. GWC days increased from 140 to 146, and NWC days decreased slightly from 59 to 58.
So, a slight increase in both inventory and receivable days. It's something to keep an eye on, but not a major red flag. Now, let's move to the way forward section, as highlighted in this presentation.
The way forward slide outlines their strategy for the coming year. They expect the demand environment to improve gradually, with a likely growth uptick compared to financial year 25. The company is committed to scaling existing brands, including adjacent categories, while maintaining tight control over working capital and focusing on free cash flow generation to drive higher ROCE. Profitability improvement remains a key focus, led by operating leverage and a better channel mix. Additionally, they plan to accelerate retail network expansion across brands using an asset-light approach and will continue to invest heavily in marketing for better visibility and consumer connect, all of which should support their growth and profitability ambitions.
That sounds like a comprehensive plan. They're clearly focused on both growth and operational efficiency.
Exactly. It's a balanced approach, scaling up, staying efficient, and investing in brand strength and reach.
So, overall, a solid performance by Arvind Fashions, with growth in revenue and strong improvement in profitability. The company is navigating a challenging market environment well, and the outlook seems positive.
Agreed? Let's wrap it up there. The presentation ends with a simple thank you slide.